In this video, you're going to learn what a profit and loss statement is. I'm going to show you what it looks like and how you can use it to measure your business's financial performance. I'm Colin Sweetman from First Accounts. Welcome to episode 3 of Financial Understanding. As a business owner, you need to know what a profit and loss is trying to tell you. You need to know what it says about your operations and financial performance. Basically, whether it's profit making or loss making. In this video, we will look at its structure and format and all of its components. Let's start with a definition. A profit and loss statement shows how much your business had earned and spent over a specified period of time. This can be displayed over months, quarters, or years, and will tell you if your business is making a profit or a loss. A profit and loss statement might also be called an income statement, a statement of operations, a statement of earnings, or simply abbreviated as P&L. These are all the same thing. In its most basic form, it is essentially a high-level summary of a business's sales less its expenses over a defined period of time. When we take our total sales in this time and subtract our total expenses, the result is either a profit, which means sales were greater than expenses, or a loss, meaning we spent more than we earned. And this is why it's called a profit and loss statement. It will show us whether a business has made profit or loss over a certain period of time. That time period is typically monthly, quarterly, or annually. Typically, monthly and quarterly statements are created for management to make decisions going forward, while annual profit and loss statements are made for tax and company law compliance reports. In many ways, the profit and loss statement is a moving picture or film of the performance and activities of a business during the defined time period. You are seeing all over the action over this period of time in one go. Let's take a more detailed look at the profit and loss statement. Income less expenses does not give us enough information about the financial performance of the company. We need more detail. For instance, with income, which may also be called revenue, sales, or turnover, we may have services income and product sales as two distinct line items within total income. This extra information helps readers of financial statements to understand more of the business operations, what it sells, and how much it sells. You can even go into further minute detail on each product or service line. For now though, let's keep it more simple. The same principle can be applied to expenses, of which there are many categories. There are two main types of expenditure: direct costs and indirect costs. Direct costs are those which rise and fall in tandem with sales. For example, if I run a cafe, the more coffee I sell, the more coffee beans I will need to buy in order to sell that coffee. That is a direct cost to my business. Typically, we would call this a cost of sale. Conversely, indirect costs bear no direct relation to my level of sales. For instance, if I had to get public liability insurance for my cafe, it doesn't matter whether I sell 10 cups of coffee a day or 100 cups of coffee a day. That cost will stay the same. Cost of sales expenditure is inserted into the profit and loss statement right below the income lines in order to work out what we call the gross profit, which essentially shows me how profitable my products and services are to my business. A business that sells services might call cost of sales cost of services rendered, and a business that sells goods might call its cost of sales cost of goods sold, to be clear on what the cost is in relation to. If you are running a retail, wholesale, or e-commerce site, typically, the cost of goods will be the direct cost you paid for those goods. If you are running a manufacturing business, the cost of goods would typically be the cost you paid for the raw materials and the cost that the direct labour took to make those products. Let's go back to the cafe example again. We are trying to go back to the profit of the coffee, less the coffee beans, milk, sugar, and the paper cups. When we add up all our sales and take away our cost of sales, we end up with gross profit or loss. Gross profit is extremely important in determining if our products and services are generating enough margin to sustain our business. It also measures the efficiency of the production and sales process. All other expenses are considered indirect costs, mostly because they have no direct relationship with sales. Not all overheads are fixed, though. Overheads can include fixed costs like premises rent, employee salaries, software, insurance, legal and accounting costs, broadband, and depreciation. Some indirect costs can also be variable and depend on the level of activity that's going through a business, but still cannot be directly correlated to sales. These variable items include spending on things like marketing and advertising, light and heat, repairs and maintenance, bonuses, commissions. When administrative expenditure is deducted from gross profit, it gives us our operating profit. Operating profit is essentially the residual income that is left in a business and generated from its operations. It's what is left over once we have deducted all direct and indirect costs from our sales. Next, we need to work out our profit before taxation, which essentially means we need to deduct financing expenses such as interest from our operating profit. Finally, the last expense to deduct is tax, which in Ireland is currently 12.5% of profit before tax for limited companies. The final result is profit after taxation, which is the residual amount of profit that is left over and can be reinvested in the business or distributed to the business owners. So what do we do with all this information? Why is it useful to us as business owners or for other stakeholders in the company? Firstly, this information is useful from a compliance perspective because it allows us to work out how much tax we owe. But more importantly, we can use this information along with other historical information and compare it and measure our growth and identify areas of concern or just try to explain certain patterns. A comparative period is simply a different period of time, and we can compare it to whatever we want to compare it to. For example, we can compare one month to the preceding month, or the same month for the last year, or even to a budget month to track the business performance against its forecasted projections. When we use comparative periods, we can calculate the change or movement across each line item or category of the profit and loss statement. As accountants, it is our job to support and explain each movement and explain the causes of the movement. Let's dive deep into an example business to see what information the profit and loss can reveal about a business. Here we have an example company's profit and loss statements for the month of May and June. As a general rule, the most recent time period is shown on the left. The company had a seemingly successful June, but a poor performing May. Let's see what story the figures can tell us. The first item to note is that sales have increased by 20%. However, we can also see that the cost of sales have increased by 32%. The gross profit has also increased in line with sales, but not by the same percentage. We can also see that the overhead expenses were higher in May than in June, and this has positively affected operating profit. So what story can we extract from this? On analysis, we find that in May, the managers of the business increased their advertising spend by €15,000. This has had the effect of increasing sales by €40,000 in June, or by 20%. Naturally, our cost of sales increased because of the uplift in sales. However, the cost of sales, which are normally 50% of sales, should have been €120 according to this margin, and not €132,000. What happened there? Well, it's apparent that the managers gave a 10% discount for the month of June, which can be seen in our gross margin variance. If we look at forecast net profits, the business normally makes €40,000 per month. During May and June, the business only made €73,000 instead of €80,000, which was projected. This has left a management variance of €7,000. By analysing the profit and loss in this way, management now knows that advertising campaigns coupled with sales discounts may not work in the future. Of course, there are other factors to consider when doing such an exercise, and one could even argue that the problem was that not enough advertising revenue was put into this sales campaign. But the key demonstration I'm trying to make here is that management can use the profit and loss to make key decisions for the future. The profit and loss statement is just one statement which can be used in this way. Now we'll look at some real life financial statements and show you what they mean and what they can do for a business. So first I want to start with the profit and loss account, which is also sometimes called the statement of profit and loss. First we have turnover. This is kind of like a video of a company's financial business over a period of, let's say, a year in this case, so 2020. I'm assuming here it means 1st of January to the 31st of December 2020. The profit and loss statement is a financial statement that summarises the revenue, costs and expenses incurred during a specified period. That's the ultimate definition for that. Revenue is essentially all of the company's sales or earnings, and it does not include VAT. Cost of sales indicates how much a retail or wholesale business spends on the products it purchases from suppliers, typically for resale. And gross profit is the profit a company makes after deducting the costs of sales or the cost of its services. So it is directly related to the turnover of the company. So in cost of sale will typically include merchant fees, distribution fees, staff costs if they were directly involved with revenue, like catering services, for instance, and of course products. The rest of these are mostly sometimes called overheads. Overhead refers to the ongoing expenses that are not directly attributed to creating a product or services, but nonetheless will keep going on. They're at a fixed rate. If you sell more, overheads will stay the same. If you sell less, overheads will typically stay the same. They're not directly correlated to sales. If you had no sales, you could still have office rent, telephone. These are the bills that will come in all the time, no matter what. Now, operating profit is also known as EBITDA. That's earnings before interest, tax, depreciation and amortization. The reason why this is important at this stage to highlight is because we are now at the profit that is controllable within our business. We don't have much control over interest rates. We don't have much control over tax rates. So that's why this is a good metric, and you'll often hear that EBITDA is what managers and directors are judged upon. Of course, now we have interest expense and the tax charge and profit. The profit here for the financial year, the ultimate profit, is essentially what the shareholders will see as the profit that could be made as a distribution in the form of a dividend. Typically not, typically it's reinvested, but this is theoretically the profit the company has made after taxes, after interest, after depreciation and amortization. Well, that's it for this episode. We hope it was useful to you on your business journey. If you have any questions, of course, please feel free to comment in the comment section below, and hopefully you'll watch the next episode and it'll be equally as useful to you. See you in the next one.